we have a illustrious panel to walk us through some of the issues and help us understand the dynamics. Obviously, this recent fall in oil prices is quite dramatic, 50% over the last 6-7 months, one of the longest and sharpest declines for many, many years, and indications that this price level will be with us at least for the immediate future. Our panel will try to help us understand first sort of the causes, the structural causes in the marketplace that perhaps help bring this dramatic oil price decline about, as well as maybe some of the political and economic decisions that may or may not have been made and that led to this consequences. Then to help us understand what are the current dynamics of this level of oil prices, how long possibly is it likely to last, who are the winners and losers, what impact is it having in the region, obvious countries that rely a lot on oil revenues might be hurting more than others. Others that are net importers might be doing or might be fairly happy about this. So to understand what are the dynamics of the current phase, both in terms of market dynamics as well as some of the political and economic thinking that might be happening either in OPEC or in the various regional capitals, areas of agreement, areas of disagreement, leading us to understand the way forward, or how is this likely to play out over the next 6 months to a year or even 2 years. As I said, we really have an excellent panel, and I thank them all for accepting to join on this panel today. In the order in which they are seated, in which they will speak, we will start with Dr. Herman Franssen. He's a non-resident scholar at MEI, but he has many other illustrious positions. He's the Executive Director of Energy Intelligence. He's President of International Energy Associates, a Distinguished Associate with Fasharaki and Associates, Senior Associate at CSIS, and a Fellow at the Center for Global Energy Studies. He is a member of several advisory boards of companies and publications relating to the oil industry. To his left is Minister Chakib Khelil. Minister Khelil is the former Minister for Energy and Mines for Algeria between 1999 and 2010. And during that period, he held many additional posts, such as President of the Gas Exporting Countries Forum, 2010, President of the Association of African Oil Producing Countries in 2004, President of OPEC in 2001 and again in 2008. He's also worked with stints at the World Bank and other institutions, and we're very happy to have him with us today. To his left is Dr. Francois Seznec, also an adjunct scholar at the Middle East Institute, but a professor at Johns Hopkins SIAS, School of Advanced International Studies, a lecturer at the McDonough School of Business at Georgetown, and at research centers on the influence, his research centers on the influence of Arab, Persian Gulf political and social variables on the financial and oil markets in the region. To his left, last and definitely not least, Dr. Sara Vakhshouri. Sara is the president of SVB Energy International. She is an internationally recognized expert on the energy market and security, with extensive experience in global energy market studies, energy security, and geopolitical risk. She's worked both in the public and private sector in the Iranian energy industry, and has traveled and worked extensively in the Middle East region, India, and North America. We were going to start with Dr. Franssen, who will start us off in this discussion of the causes and dynamics that led to the current price levels, followed by Minister Khelil, who will discuss sort of the OPEC perspective and his expertise and experience about what the thinking may have been and is today possibly there, followed by Dr. Seznec on the Gulf perspective in the Arab countries, Saudi Arabia in particular, and then Dr. Vakhshouri partly on the Iranian perspective on this, as well as sort of lessons learned about the rise and fall of these oil prices as we've seen today. So without further ado, Dr. Franssen, please.
Thank you very much, Paul. It's a pleasure to be here, and I think it's very opportune for the Middle East Institute to have this meeting on oil and its impact on the market and on the region. Trying to figure out how this thing works. You know, maybe this one of these? Maybe one. Oh, okay, it's good. There you go. Thank you. I'm technically not very good, sorry. Well, I just put this in part because what we are witnessing today in the oil market is a significant drop since started in the summer of last year. It's not new to those of us who have been in this business. We had a huge drop in 1986, and OPEC had miscalculated the ability to keep prices at that time. They were very high in $30–35 per barrel, which in today's dollars would be over $100 a barrel. The market couldn't sustain it, and subsequently got an enormous drop in the demand for OPEC oil. And by that time, they started reacting, and the Saudis were doing the same thing as they did last year. Decided, well, enough is enough. Let the market decide on where this price will go, and the price dropped dramatically. Started in early 1986, and by the summer of '86, some cargoes of crude were sold at $6 per barrel. It was quite dramatic, but the surplus capacity within OPEC was 50%. It was so huge. It basically took 15 years before all that surplus was eaten up in the market, and so it was not until the first decade of this century that we saw a significant change in the market, and that was largely due to the enormous demand growth in China. But here you see the immediate reaction of what happened in the oil price to OPEC revenues. OPEC supplies remains fairly stagnant because it's going to take a lot of time before that market share will increase even if prices will remain low. Now imagine you were in Mr. Naimi's shoes last year when they made that decision. You had an enormous increase for years in U.S. oil production, what we call tight oil. And tight oil is something entirely new. It's a technological revolution that people in the early part of this century, basically in Texas, trying out various existing technologies to profitably develop first gas and then liquids from what we call the source rock, because in the past, oil and gas migrated from the source rock to higher level, get trapped, and you produce it. But this is a real breakthrough, that you could profitably produce oil from the source rock, from the shale. And that is a breakthrough that will be with us for decades to come and will have a major impact on global markets. And so for several years, there was no growth in non-OPEC supply outside of North America. You go look at all the IEA numbers, going back 5, 6, 7 years, no net growth in non-OPEC supply outside of North America. All the growth was in North America. And on the demand side, demand partly for structural reasons, because we have become much more efficient. We have moved away from oil to more natural gas, renewables. All that has significantly reduced the growth of natural gas. On top of that, now China is moving into a different kind of economy, no longer double-digit GDP growth, but single-digit. And we don't even know if the 7%, 7.5% is the actual growth rate. So there's significant reduction in the growth rate of oil, even outside of the OECD countries. Now, you are sitting there, you are Ali Naimi, you get all these reports because they're extremely well informed. And you get the IEA view and the OPEC view. The IEA view for 2015, well, demand is going to be rather modest. But the Americans will keep on producing at $100 a barrel, another million barrels a day of oil from shale and other. Their offshore is doing well. And the Canadians also will continue to increase oil from their tar sands. At the same time, the demand growth is going to be very sluggish, I'm sorry to say, because the Europeans are in bad shape, their economy. The Chinese are growing at less than they did before. We have in place a lot of government policies like the CAFE standards, making cars by law more efficient, etc., etc. So the demand grows as less and the supply keeps growing. So what you're going to do? You're going to lose market share as OPEC if you keep supporting that price at $100 a barrel. The OPEC was even a little bit more pessimistic. The OPEC view was, well, the supply, the demand is going to be about the same as what the IEA said. But looking 5 years out, and that's important, here you see where it says implied OPEC, the IEA view for 2015, and the OPEC view was about the same. But you look 5 years out, and you look particularly at the OPEC one, by 2020, OPEC could still be, the demand for OPEC oil would still be less than what it is today. So basically to the Saudis this was too much to accept. The losing market share, also keeping in mind that within OPEC, Iraq wants to have a bigger share. They have enormous resources, and they want to increase production significantly before they're held to the same rules as others in terms of production quotas. And Iran, if there is an agreement between the P5 and 1, if by the end of March, then many of the sanctions will be lifted, the international sanctions, and Iran can be expected to produce several 100,000 barrels a day this year. You know, and that's not even in these numbers. And more so in 2016 and so on. So if you are looking at it from the point of view of Ali Naimi, the minister of Saudi Arabia, that's not good news. So then they decided, well, OPEC will give you a proposal. If you guys join me and we'll cut 1 million barrels a day, we'll take our share, you take some, and then we want the Russians and others to cooperate and also contribute some. Of course that didn't work, and Minister Chakib has that experience in 1990, I had that experience when I was in Oman in 1986. They always said, yes, yes, we'll cooperate, but they never did. So it really, in the end, all came down to OPEC. Is OPEC going to cut 2 million barrels a day, approximately, which was needed to remove the expected surplus, or not? So since there was no agreement to cut or expectation that countries would follow, the decision then was made to let the market, that make the decision. And subsequently we see that the price fell very sharply, and it's now down to about half of what it was in the summer of last year. The demand will remain sluggish. We'll see the impact now is going to be considerable in the United States from, I think, from the second half of this year onward. So far it has not yet been significant. In part because it takes time to adjust. I mean, people had plans to make, to drill wells. Major companies, sometimes they hire the services, oil service companies, for the period of a whole year. The whole variety of reasons. You have commitments, drilling commitments that you cannot immediately cut back. Smaller companies can do that easier than bigger companies. But you're beginning to see already a significant change. The number of drilling rigs now is already somewhere around 500 below what even more than 500 below what it was at the peak last year, and it keeps falling. So there is less drilling, and less drilling will have an impact on the production a little bit further in the year. It is now expected that when we get to the second half of the year, but towards the end of the year, we may see basically the growth in this non-OPEC, in the U.S. oil production, not only slow, but come to a halt. It's not going to, we're going to see a decline in production, but kind of a very small growth to no growth. But the year average will still be maybe 500,000 barrels a day, maybe even a little bit more year average for the United States. But if the price continues to be low, then next year you could see very well zero growth in the United States, or even a slight decline if the price remains at the kind of current level. Elsewhere in the world, it has the major impact on the major oil companies will be a postponement of a lot of projects. And you won't see the impact right away, because these postponements will only, you will see that in the marketplace in reduced growth in their production several years out. So if the price, for whatever reason, and I don't think it will, but will stay low for a very long time to come, then 5 years from now, we'll see another cycle upward. And we could see another significant rise in the price. Because not only will you see that slowdown in these very high-cost projects, like, here, these are a lot of high-cost projects. As you see here, for example, the break-even price Middle East is it's relatively low-cost oil. But the higher you go out, you go to Arctic oil sands is very high. So nobody today will invest in new oil sands projects because you need about $75. Well, these are kind of, overall numbers differ from project to project. But if you look at the North American shale, it's relatively high cost. You see that range there at the end in the North American shale. Some say that 65 is kind of that price. You're beginning to see a decline. If it is much lower, the decline will be sharper. Because there is another element in there with the shale oil, is that you may say, well, American oil, WTI, the benchmark crude is at $50, but when you produce that in Bakken in North Dakota, the transportation cost by rail, because there are no pipelines, from there to Houston, where the refineries are, is $15. So at the wellhead, you get only $35, not $50. So all that is factored in, and you can see here, if the price, which is now around $50 for what we call WTI, the American benchmark, about $60 for Brent, at that price, a lot of things are not possible. I won't go through this because it's too small. But here you see, in America, you see the average WTI break-even oil price by play, because each play, each area, each basin is different. And you see you have relatively low cost on your left and relatively high cost on the right. And within that, you have a lot of variations. So when the price remains low, a lot of this stuff cannot be produced. This one tells you basically the same story, liquid production for shale per month and the Brent oil price. That in the worst case, you get a very sharp decline if you have very low oil prices. In the high case, you have very large growth. So will the situation be better at the end of the year? Well, our chief economist, some of whose material I'm using here, he is among the bears. He doesn't think that the market will improve sufficiently to see a significant change in the price by the end of the year. And that it will really be sometime in 2016 where the adjustments are going to be made to see actually a slowdown, if not a decline, in non-OPEC supply and some growth in the demand as a result of a recovery of global economy and the low prices. But what is complicating it now further, the market today is what we call in contango. That means the future prices are higher than the current prices. So what does that mean? If I'm a trader, I can go and buy Brent 12 months out for about $10 more than the Brent is today. The Brent price is today. Or $7, about $7, $8. So with interest rates low, it's worth my while to sell crude out 12 months and buy today's crude. In the meantime, you can make a lot of money. So what is happening is that a lot of production now goes in storage. But when the storage is full at this rate, in other words, the demand isn't picking up, then there will be so much storage that it will be practically full by the end of the year. And we could see then this contango, the current price and the year-out price will begin to become more even, and it's no longer worthwhile holding the storage. People will start dropping storage. So in 2006, you could see destocking from the very high level of stocks, and that could have an adverse impact on the price. So all these things, that is why there's so much uncertainty in this whole thing. But obviously, and I think others in the panel will focus on that much more, there are a lot of other reasons for the price fall, and these are not talked about very much publicly. And one is that to some countries it's advantageous to see Iran and Russia punished for what they perceive to be their bad behavior. We see that today Russia has very serious problems with the economy. Iran has serious problems with their economy. And if the price remains low, those problems will be more serious. So this is the last one I just want to show, is that yes, a lot of OPEC countries have serious problems. what their break even, what they need for their budgets, are from, this is just one example, from Qatar very low all the way up to Iran very high. Of course, you can say, well, you can cut back, and I think that's what you're going to have. People cut back on their budgets. A lot of things that they're planning to do, they can't do. But other countries like Venezuela will be in very difficult shape. Just exchanging views with Minister Khelil, that Algeria happens to be one of the countries that's sitting on very substantial foreign liquid reserves, so they can sit it out for a while, and in particularly the Gulf countries can sit it out for a while. If the Saudis have 40 billion deficit, they have $750 billion of liquid assets. They can do it for a few years before they find that you have to do something about it to change the situation. In the meantime, for the US, and that is the big dilemma for the Saudis and others. As soon as the price goes back up again, we are back into the $70 to $80 range. This begins to turn around. Not sharply, begins to turn around. More activity will take place of that tight oil, and more of it will be produced. The price goes up higher than that, it will be even more than that. So it's a very difficult time. It's not like it was before, that it will be more difficult for OPEC at a higher price to sustain market share. So maybe the kind of long-term equilibrium price is closer to where the US still adds a little bit, but not as much as it has in the past 5-6 years. So we're talking about maybe $70, $80 a barrel, and that is what perhaps the major oil companies and OPEC will have to learn to adjust to. I'm not saying that this is the price in the future, but this is what the kind of the picture you get from the tight oil, the shale oil, you would get if prices were to return to that price level. Thank you.
Thank you very much, Dr. Franssen. Thank you very much for sharing that analysis, the insights, and very valuable and clear data to help us understand the elements at work. Minister Chakib, if you would like to take the podium.
Thank you, Paul, and thank you very much for inviting me to this panel discussion. I'll deal with 4 questions. Basically, what is the impact, of the OPEC decision on its own members, but also on non-OPEC production? I think that's the first question, which is very important. And how is the oil market likely to perform, this year, in view of our present take? I think Herman has dealt with that a little bit, so I will deal with it maybe from more of the point of view of the OPEC, countries. And what is our take on the growth of demand and OPEC and non-OPEC production? I think that's the second question. I think one important thing also is what can we learn from, the previous crisis, because we had various crises. I attended 2 of these crises in 2001, 2008, and actually in 2008 we took a major decision in the Oran in Algeria meeting, where we cut down OPEC production by 4.5 million barrels per day. That was the largest cut we made, in 2008. And then the last question is what options OPEC may have when it meets in June, because they have a conference in June. There have been talk recently about emergency meeting. I don't think that's going to go anywhere. So what is OPEC decision, impact, of November 27th? And like Herman said, OPEC did exactly the same thing it did in 1986, which was to engage in a strategy to defend its market share. And what it's trying to do there is trying to reach a new equilibrium between supply and demand, not through actions by OPEC, but through the mechanism of the market. But I think one question which is very important, does actually OPEC have a strategic objective? Because you hear OPEC members mention, what their objectives are. So I don't think OPEC at this stage has a common shared, objective, but we'll talk about that. The impact on OPEC members have been, due to this market adjustment, has been financially and politically very difficult for many OPEC members, especially difficult for those with high debt, like Venezuela, or those that have just a slim cushion of, hard currency, like Nigeria, or those whose economy is not as diversified, like Venezuela is highly dependent on oil revenues. Algeria is highly dependent on oil revenues, but of course Algeria, like Herman mentioned, has, high cushion of hard currency. Because the reason is that the member countries are aware that social and political problems, could evolve, out of this situation and may destabilize, the member countries. And of course, if that happens, then of course the oil market could be also affected by that situation. And these are the difficulties that actually shape, the outlook of the members on what OPEC strategy should be. So you have those that have supported this defense of the market, and those who were trying to go for a cut. What would happen then to the non-OPEC production? If we look at the competition for OPEC oil, those are non-OPEC countries, United States, Canada, you have Colombia, you have Brazil. I think the question that we need to ask, and I think Herman had asked it, is whether this strategy would eliminate, this competition, definitely, or would it delay it only for a period of time? And I think I'll go back to the past experience to say that the technology and better management would allow the non-OPEC countries, their reserves and production, to come back in the race later on. And we have seen that in history with the development of many new technological developments like 3D seismic and secondary recovery and offshore drilling and so forth. And the pace of return of this non-OPEC production may be decided, of course, by the economics of specific projects, but also, I think, by the lessons that to be learned now by non-conventional oil. When I put in non-conventional oil everything, the oil sands and tight oil, shale oil, during this present crisis. So the lessons to be learned in this present crisis will be, used to develop better ways to produce possibly, oil at lower cost. The issue which is also important is what is the impact on non-conventional oil right now by this decision of OPEC. I think we should start by saying, and I agree with Herman, that non-conventional oil has contributed the largest share of oil volume growth in the last 4 years. And during this time, conventional oil, which means your conventional oil from big production, has either stagnated or even declined. So your main growth is coming from non-conventional oil during the last 4 years. And while we see that some of this non-conventional oil is being taken by lower prices, some of it has been affected, the total volume reduction is not known with great certainty at this time, because there are so many variables. I think Herman alluded to that, like the technical, of course, economic, and financing schemes. Lots of these projects have been financed, through junk bonds and other types of financing schemes, which possibly in the future they may not be able, to use because of the high volatility of the price of oil in the future. It's not really stable. You cannot determine it, so it may be very difficult for non-conventional oil to use that type of financing. But I think lots of people have made some good estimates how much non-conventional oil, have been reduced And based on the rig counts, for example, rig count now is about the same as it was in mid-2011. So it has gone down, quite a bit. And also because of the postponement of capital expenditures. But I think all market watchers agree that the largest reduction of non-conventional oil would occur during the third and the fourth quarter of this year. So we're going to see a major, reduction at that time from non-OPEC oil. Now, based on at least what OPEC sees as the oil market, the demand growth that OPEC sees is about 1 million barrels per day, which is about a little bit higher than 2014. But it's concordant with the growth rate, in the global economy for 2015, and a non-OPEC supply on average of 1 million barrels per day, which is basically all the growth in demand this year will be satisfied by non-OPEC, oil growth this year. But if we assume that OPEC maintains the same rate of production as in the last month, which is about 30.2 million barrels per day, we should see a big overhang, we call it overhang, of about 2 million barrels per day in the market during the first semester, which means this quarter and next quarter, because, the seasonal demand, is decreasing in the first and second quarter. And of course, you have an increasing non-OPEC, still increasing non-OPEC supply during this period. And this is the reason why you have such a big drop, in prices, but also the high volatility in prices, which is a new phenomenon due to the decision made by OPEC, because of the uncertainty tied, to when and how much, the non-OPEC reduction is going to be. And like Herman said, as onshore storage, gets fuller, operators are going to look at offshore storage. That could be rewarded in this market, which is in contango, which means the prices in the future are higher than at present. But if we look at the second semester, the situation completely changes, because the big excess of overhang that we saw in the first semester disappears. In the third quarter, we would have only a very slim overhang of about 0.1 million barrels per day, which is 100,000 barrels per day. And we shift into a deficit in the fourth quarter of about 400,000 barrels per day. So that's how we see the OPEC sees the market, in the third and fourth quarter, which is a tightening of the market during that time. And the reasons for this outlook during this second semester are a combination of the increasing seasonal demand, because seasonal demand increases in summer and the fall, and of course the decreasing non-OPEC supply. And this explains why we should be seeing a tightening, of prices during the second semester. But I think I'm asking two important questions at this stage, which are very important for OPEC, options in June. Would the non-OPEC production reduction that we're going to see in the second semester be important enough by itself to stabilize, the market towards what OPEC considers its strategic objective, which of course, I could not define since we don't have a common shared objective at this stage, but perhaps by June, OPEC may have come up with a common shared objectives at that time. So if non-OPEC reduction does not help stabilize, then the second question, would OPEC at that time intervene to stabilize the market toward what it considers its strategic objective? And I think that's a question that remains. Now, if you allow me, I just look at the previous crisis just to see, what we could, extend. Yeah, it just finished almost, yeah. There are similarities of course, there are differences, similarities between the various crises. There were, 4 crises, 86, 97, 2008, 2014. In only the 2 crises, 97, 2008, OPEC cut back on its production. In all crises, the prices fell between 50 and 70% before stabilizing, and we see that now. And the decline period after the peak price lasted between 5 to 8 months. So we are now in our period about 8 months, in our crisis. But the crisis of 86 was the only one where OPEC decided to defend its market share. So it's the only case that's similar to the situation we're witnessing now. It was also due to surge of non-OPEC supplies at that time. But it is to be noted, and I think Herman noted that the supply overhang as a percent of oil demand at that time was much larger than, in 2014. So it was a deeper crisis than we are witnessing today. But I think we need to say that OPEC in 86 finally abandoned its strategy by adopting a reference price of $18 per barrel at that time. If you want a very detailed historical analysis of that crisis, you read the chapter 36 of the prize of Jürgen, who details the situation. When you read it, you could see that that situation is very similar, that situation that we have now, including some political intervention, by Vice President at that time Bush with the King Fahd to tell him about how deeply the oil industry in Texas was affected, by that situation in 86. So what are the options that OPEC has in the conference of next June? I think OPEC may choose to maintain the present policy to defend its market share by rolling over the organization's quota at its next conference in June, which is maintain the 30 million barrels, It is highly likely it would do so because by then the market will be stabilizing. The members may feel more optimistic about the future with higher prices at the horizon, as the call for OPEC oil is expected to be higher in 2016. But of course, the conference will probably face very strong arguments from the high debt and or slim cushion, currency cushion members, I call them, who may not share the same objective as others. So we're going to see the repeat of the November 27 conference. The second option that OPEC may have is OPEC may choose to lower its overall ceiling production level at the next June conference to perhaps try to achieve the common shared objective among its members. Such a move should be satisfactory to all members and would require a consensus, because everything has to happen with consensus in OPEC. And the consensus may or may not be difficult to achieve depending on the production capacity outlook for OPEC members in 2016, because some of the OPEC countries may see their production actually declining, starting to decline or actually continuing to decline in 2016. And how large an adjustment they need to do. Decision on this option could be delayed until the following meeting planned in December to take advantage of additional market data during the second semester. The third option, OPEC may choose to abandon its strategy of defending its market share like it did in 86 and adopt a reference price and a quota for each member. I think this is unlikely to happen during the next conference because it requires much discussions and negotiations on quotas between member countries, some of whom are facing major political and security challenges. But it should not be discounted, as OPEC in the past concluded deals on reference prices and quotas, even during difficult times, such as during the Iraq-Iran war. Thank you very much.
Thank you. Thank you, Minister Khelil, for that very detailed view, particularly for looking forward at the meetings of June and December and what options they might have as OPEC countries. Let's turn to Dr. Seznec, perhaps with some views on the political and geostrategic aspects.
Thank you very much. Thanks. And thank you to MEI, and thank you to the panelists for really very interesting information. I think I'll have just 4 main points here. I'd like to sort of cover very quickly what are the budgetary implications of the lower prices on the Gulf or GCC countries, I should say, and mostly focusing on Saudi Arabia. And perhaps I'll try to also discuss in a few minutes what were, in my view, the Saudi motivation for pushing for the, or accepting this lower oil price. Really, basically, in that case, the 2 points is, one, it's of course an economic decision by Ali al-Naimi and the civil servants in Saudi Arabia, and also a political convergence of view with the political side of Saudi Arabia. So this will be the main point. One thing I will sort of push a little bit is that, in my view, the Saudis, one of the Saudis' motivation is really to force Russia into giving up some of their production. But we'll see that in a little more details here. I think we're seeing an interesting situation in Saudi Arabia where Ali al-Naimi has always been in charge of the oil policy of the country, and I'm sure Minister Khelil could help us on that. But he does it not so much for political reasons. I don't think he is very, I don't think his views is to push Syria, or to push Iran, or to push Russia. His view is to maintain market domination by, or regain, in this case, market domination of the oil markets by Saudi Arabia. I think Ali al-Naimi and the group, it's not just Ali al-Naimi, it's all the people in there, are extremely well informed of the oil markets in the world. They know about the North Dakota oil fields as well, if not better than we all do. So they know that they're not going to change much in the production level. I mean, I think at the conference on CSIS a couple of weeks ago, where most of us were, they actually said that the oil production of North Dakota and the U.S. in particular is actually not going to decline for the next 3 years. It may not increase as quickly as it has in the past, but it will pretty much remain stable. And then if the prices remain low, it will continue. It will then go down fairly rapidly. But Ali al-Naimi knows that, and he knows he's not going to force these companies to cut their production very quickly because there's so much on the books already that is signed and going on. The prices, the cost prices, where Herman has mentioned that, I think some of the figures which were given at CSIS were actually lower. A lot of the people were saying that the prices, the cost of this new shale oil in the U.S. is as low as $35 now. But of course, there's a range. It goes from $35 to $80. But by and large, with the new technologies that are coming out, they're really decreasing the cost very substantially. So even if the Saudis keep the price below 50, these wells will continue to operate. In my view, the Ali al-Naimi's view, and it seems that there has been numerous contacts for months now between the Saudis and the Russians, has been to really push the Russians to cut their production. The Russians will never admit to cutting production, of course, because they don't want a small country to push them into that situation, but they could let it happen because apparently the oil wells of Russia are old. Many of them are old. The foreign technology is no longer coming very quickly to Russia as it has in the past, and therefore there is a decline in production. So if the Russians let it happen, then that probably could end up cutting production from Russia by almost 500,000 barrels, and especially if it's pushed a little bit by the Kremlin for various political reasons. The thing I'd like to point out, though, is that if it is a strategy by the Saudis to really make sure that the prices remain down for some time to come, to force non-OPEC to really cut production, it's in my view what they're doing, but it is a very risky strategy. in many ways. And just as it has happened in the past, it only works if Saudi Arabia has very, very large cash reserves, which they do. But let me just go into these figures a little more. This is quite interesting to me. I've done some work lately on that. The coming budget of Saudi Arabia was published to have basically expenses of $239 billion or so. And it was computed at about $61 a barrel, according to Middle East Economic Survey, which quotes other sources. And this is all fine and good. That gives them a budget deficit at $61 of about $39 billion, which is substantial, but considering they have a lot of money on hand, they could do it. However, if we go one step further on that, every budget of Saudi Arabia for the past 5 or 6 years has been over budget by 25% at the end of each year. So they spent 25% more than what they had budgeted. Why? Because they had plenty of cash, and it was good to give money to the people at the time when there were some political issues worldwide. But mainly, these figures on the budget do not include military expenditures. And the military expenditures of the Saudis today are about $80 billion a year. So if you take all these figures together, $39 billion in deficit planned, then 25% perhaps increase, or in fact last year was 30%, but 25% increase in the actual expenditures and $80 billion in military expenses, their budget deficit will be close to $180 billion in 2015. And I really don't see how that will change, because already King Salman, to show that he's a nice guy, has given 2 months' salary extra to every civil servant in Saudi Arabia just this month. And that's going to cost $20 billion. So altogether, the Saudis have to be able to plan to spend and to have this price war they're working on, really. They've been able to match $180 billion a year in extra expenses. Now, in my view, they can do it. Because if you take their cash reserves, they publish it every month. Their cash reserve of SAMA is $744 billion today. Out of that, 97% could be actually used almost on a daily basis, on a one-day basis or a month basis, $744 billion. But they also have access to all the reserves of the pension funds, which are state-controlled, and various funds of Saudi Arabia. And they have today, these funds, $133 billion in cash. And this is published also by the monetary agency. Furthermore, and if the experience of the past works, SAMA, when they had budget deficits, and they had budget deficits for a long time, they had budget deficits from probably 1980 till about 1995, they were able to borrow money from their own banks. They did not borrow from the international community, except at 1.5 billion for a few months. But they have been able to issue development bonds to the banks in Saudi Arabia. And today, the banks in Saudi Arabia have $140 billion in cash which they could invest that way. So if you do the total of that, the Saudi Minister of Finance and the monetary agency have close to $1 trillion in cash, in near cash. So yes, they're going to lose $180 billion a year, but they can do this for 5 years and be quite happy. Now, the big question is, can Russia do that? And my view is Russia can't. So it's really a game of chicken. Who's going to give in first? Will the Russians and a lot of the other non-OPEC who are in the same situation will say, no, we've got to really agree to cut production or else we're going to lose everything. So, but the bet is very tough, because if Ali al-Naimi is not able to bring about a regain in prices, then the money will be down the drain and the Saudis will have nothing left. In other words, when the Ministry of Oil of Saudi Arabia makes a decision of really forcing prices down to 50 or 60 or whatever, they need to have the political agreement of the politicians, and mainly the king and a few of the main princes. So they are going to, they are doing that, and I think it just so happens that, in my view, there is a convergence of the points of views in Saudi Arabia today. I think the king and his group, and even the new king Salman, would love to put some pressure on Russia, would love to put some pressure on Iran. Why? Because they think that the political situation in the world is so difficult that they need to bring Iran on board and the Russian on board. I'm not one who believes that the Russians and the Saudis are each other's enemies forever. I think they know the US won't be there forever. They know they have to make a deal together. And I think they understand that what are the real problems of Saudi Arabia is ISIS, and ISIS can only be solved if there is cooperation with Iran. Yemen can only be solved if there is cooperation with Yemen, with Iran. Iraq and Syria can only be solved if the Iranians and the Saudis work together. And I think they know that very well. So if the P5+1 can give Iran the coverage and the Saudis the coverage they need to deal with Iran, they will deal with Iran. Forget about the sectarian issues. I think when it comes to very important things like money and things like that, all of a sudden these things tend to disappear. So in a way, just in my view, it's very interesting. I think we could see some very interesting moves in the very near future, perhaps which may lead to a faster increase in prices by the second quarter. But I think if the Russians will not say we cut production, they let it happen, as I mentioned before. And the Saudis may join them and let it happen as well. So there will be no big announcement, but all of a sudden there'll be 1 or 2 million barrels less available on the market. So basically that will bring settlements or easier negotiations between Yemen, et cetera, Yemen, Syria, Iraq, and ISIS between the Saudis and the Iranians. And as I finish, we'll say peace will happen in the Gulf and everybody will be happy ever after. Thank you.
Well, I think Dr. Seznec gets extra cookies for that conclusion, leaving us with between the game of chicken that he was describing and then the happy outcomes of all of this. That would be wonderful. But really, these presentations, I think, are dovetailing very, very beautifully. We're learning certainly layers of insight, and I thank everybody for that. Let's turn to Dr. Vakhshouri to hear her thoughts.
Thanks, Paul. It's a pleasure to be here today. It's fun to speak, be the last speaker after having all these distinguished panelists speaking and all very informative presentations. From chicken game, as you said, to I think you already gave the outcome. So I have been asked to speak about the lesson learned and the future policy takeaways from the current price drop. Well, still, I mean, being in Washington, D.C., of course, thinking political and geopolitics is always very important. So if anything happens in the market, we all have a lot of tendency to relate it to the political and geopolitical events around us. But personally, I believe that most of this price drop led by Saudi Arabia was for market share and just basic ration of the market. Although I believe that Saudis made me to believe that they're very good chess players because, of course, they gain a lot of different outcomes from this price, the current price trend. But I think we are giving a lot of weight to Saudis for the current prices, which I think this will be misleading for looking on different market effective factors like the stock market, that any psychological effect on the market, if any speculator sense that Saudis are not going to reduce their production or OPEC is not going to reduce their production, the effect of these psychological worries is going to be multiple by at least 7 times because of the volume of the paper contracts and trades. Also, as a very interesting point, point that Herman mentioned, also Ambassador Khalid alluded to, the contango situation in market and a lot of uncertainty in the market. If we look at the paper market, the options contracts for delivery in December, we see a huge gap between the cheapest to the most expensive contracts. $24 is the cheapest, $124 is the highest. So there are a lot of uncertainty in the market of how things are going to move. And going back to the Saudi-Iran game, I personally don't see a lot of oil rivalry between them. Of course, there is a war for gaining market share, and signing a long-term contract would be a best strategy goal for any major producing country, especially if you are neighboring countries and you have the same type of heavy crude oil that is so close to each other. You are in the same market. The same type of refineries are purchasing those from you. But as far as like observing closely Iranian policy, they are moving more toward being to build upon their refinery capacity. And I agree with Herman, if they reach to an agreement with P5+1 by the time the deadlines are like what we are expecting, Iran could add 200 to 500 between 6 to 9 months. Of course, it's going to be not as easy as before, because the lower oil prices will leave less money in their pocket to invest on their current production capacity. However, we always receive a lot of questions from people around town that, okay, if Iran reaches to agreement, and if there is any investment, where are these oil going to? Iranian already in the past 2 years increased their production at their refinery capacity from 1.5 to close to 2 million barrels a day. Saudi is already having the biggest in that neighborhood with 2.2, and Iranian are planning to increase 3.6 100,000 more barrels if the Persian Gulf Star refinery comes into the circle by 2017. 120,000 barrels more will be added by the end of this Persian New Year, which is starting on March, the next March. But so totally very soon, by 2017, Iran is going to have something close to, if things go well, which we are expecting some delays because of the lower oil prices, and maybe because if their investment might have some delays going to Iran, but they are targeting to increase their refinery capacity to 3.3. And if Iran can theoretically reach to 4 million barrels of its highest, close to 4 million barrels of oil production a day, this is before the sanctions in 2012 implemented on Iran, the highest was in 2009, then Iran will only have 1 million barrels to export, which is the current number in the long term. So we don't see Iranian crude oil as a major game changer in the future market, but they're going to, of course, investing a lot on exporting products, and they know that Saudi already has lots of long-term contracts for crude oil. So they know that this is the best place for them to play, because Saudi cannot build more refinery capacity having long-term crude oil contracts very soon. So that's how they're seeing it. So something that happens, I think, is just the current low oil prices push the major producers to revise their strategies, and things could be changed. Particularly, one thing that we're expecting that's going to change is the energy trade ties. And that's, the markets are going to change. So if Iran is looking on being more of a refined producer, refined petroleum exporter, then its crude oil market has been changed. These shares are going to, of course, go to other countries. Already we are talking to some of our clients. We know that one of Iran's biggest Asian customer is going to stop buying from Iran. The reason they haven't stopped purchasing oil from Iran is just because the U.S. State Department doesn't want to deal with other smaller countries buying Iran, and this Asian country is transparent, easy to negotiate with U.S. State Department to keep it within the limit. Why? Because simply Saudi Arabia gave the better terms to this Asian country for long-term oil contracts. So energy trade ties are going to change, definitely. Something that is going to change or could change as a lesson learned for most of the energy producing countries that are mostly heavily dependent on their oil revenue for their economy is just taking this good opportunity of low oil prices to take advantage of it to reduce their fuel subsidies. Iran, I think, is the only one in the Middle East that could successfully, and that's because of the pressures, of course, economic pressures to start an aggressive reduction of fuel subsidy. However, because of the devaluation of its currency, couldn't save a lot of money from there. The government is planning to save some more, of course, this year, this new Iranian year, starting in March, I mentioned, from reducing their fuel subsidies. Again, fuel subsidies on some of the major consuming countries like India and China, this could be, again, a fortunate time for them. We know that in India, Modi government is keen to reduce, to take the diesel subsidies. That will reduce the diesel prices in India because, of course, the current diesel prices are less than what with subsidies government was offering to people. But we think that even in the consuming countries, all these governments that were blessed with low oil prices, they are going to have challenges at the time that all the other panelists alluded to by end of 2016 or further if the price is going to go higher. Something very interesting for us as a lesson learned is just looking at Mexico. The way they hedged their crude oil, export crude oil, is fascinating. And this is something that no country really did in this massive scale of hedging, having a sovereign hedge. So what they did, basically, part of their oil export that is directly financing the budget, the budget share of their oil export every year is hedged by the finance minister. So they would agree on a set price, and then they would buy these massive massive stocks from investment banks. And they were very fortunate before the price drop to negotiate the price of $76.40 for 2015. So slightly below $81, which is their even break price for their budget, official even break price for their budget. So they're going, the estimates, EIU had an estimate that this hedge fund cost around $700 million for Mexico, but is going to avert losing $7 billion for this government. And of course, like any other oil producing country, Mexico is going to lose around 22% of their revenue this year. But having that hedge, hedging their crude oil, export crude oil, prevent this country to lose 44% of their exports. So we think that this is a fabulous strategy if it's doable for some of the major producing country. Of course, some of the major producing country like Saudi Arabia or others have been mentioned earlier. They are fortunate with having a big fat funds of foreign reserves, but the strategy of hedging their export crude oil, I think we were one of the very interesting lesson learned at this position of the market. The other thing that we think is the changes in investors' attitude, of course. At this point, we think that the relatively more efficient crude oil or lower cost crude oils are going to be the ones that are going to draw more attention and attraction for investment. Again, I would like to mention Mexico again, and that's because of the reform, the massive legal reform in their energy industry they did. So they're kind of ready for that investment. And although many are expected that the higher cost projects that Mexico is expected are going to be delayed, simply because of the low oil prices. But on the other side, in the Middle East, the countries that we are looking for potential investment would be, well, Iraq, that already has some investment but is tackling with domestic political turmoil, and already the foreign companies left God knows when things are going back. The other option would be Iran, of course, eagerly waiting for having international investors. Iran did some reforms on their contractual system, the investment regulation. They're trying to make it more attractive, but still, I think there would be they could make it more interesting the way other countries like Mexico did it, the way the reform happened in their constitution and the projects they're offering. I think they're having much more interesting contracts to offer. So basically, I myself view this time as a very interesting point of history of the oil market, that things could change from energy trade ties to market and sell strategies, domestic fuel subsidy strategies of many of countries, and also to protecting their domestic revenue by hedging or coming up with new strategies that if there are countries that are highly dependent on their oil economy, at least have some protections for their oil revenue. I'm going to stop it here, so I know that we're going, according to plan, to have some more discussions, and looking forward to more questions.
Thank you very much. Thank you, Sarah, for those insights. Also, talking a bit about Iran, also linking these sort of international price issues to domestic policy changes and ways that could be impacted as well. Before turning it to questions and comments from the audience, I just have a quick couple of questions, maybe to Herman. On the U.S. side, how has the White House, has U.S. administration dealt with this situation, crisis, change, or whatever? The U.S. maybe geopolitically benefits somewhat. Russia is weakened. Iran is squeezed. Maybe for gas prices, it's good to have lower gas prices, but then there's an impact on the oil industry. My question is, how has the administration dealt with this? Do they have a clear policy? Are they trying to push in a certain direction? Maybe Herman or others could comment on that. And a quick question maybe to Minister Khelil. Obviously over the last 4 years, we've been, we and others, around the world concerned with so-called Arab Spring countries and the demands of people and all of that. So I have a quick question. How do you see this impacting Tunisia, Egypt, Jordan, Morocco, countries which are not oil exporters but have very large populations? Is this clearly good news, or is it mixed news? From your experience, what would... Thank you. So those are my two quick questions, and if you would like to prepare your questions, I will go to the audience next. Herman, do you want to comment on the U.S. issue?
I'm not aware if there is any particular policy as a result of the low prices. What, of course, it will do if prices remain low for several years to come is it reduces the optimism that there was before towards U.S. self-sufficiency in oil, even North American self-sufficiency in oil. I think this White House has not been very friendly to the oil industry. You see that in the reactions to the Keystone XL pipeline, which would help North America as a continent to become more self-sufficient. I think the White House, the policy has been to accept natural gas as a kind of a transition fuel to renewables, but it's not very friendly to oil. But what we haven't seen is any reaction that we saw, that you mentioned, to Bush Senior, to try and interfere with Saudi policy objectives and say, well, we don't really want you to do it because it affects our industry. I think we'll just go and wait and see to what extent the reaction will come on the supply side. And to be very honest, we don't really know. We have to wait until the end of the year to see what the prices will actually have done to this tight oil production overall, as opposed to taking one price to look at every single basin that we have.
Thank you. Minister Khelil, maybe on the other countries?
Yeah, I think you mentioned Tunisia, Egypt. I think these are, now importing countries. Egypt used to be exporting, countries. Now they are in the process of importing natural gas, from other countries. That talks about Egypt importing gas from Israel. But they have been in talks with Algeria to import LNG. So Egypt is in a difficult, situation. Although, of course, it would import oil cheaper now. I think the main issue I wanted actually to mention it is the strength of the dollar. With a strong dollar and with a deflationary, environment in the world, the exporting countries are not in such a bad shape as it looks like, in terms of the first purchasing power. And of course, because of the strength of the dollar, they have increased, revenues. Since some of these countries, exporting countries, buy their goods and services from, euro, area. So they're going to buy cheaper, in euros and get very high income in dollars, although their income is tied to the volume, they export. So that's a very important point, I think, to make when you look at the deficits, of these countries. It's a very important point, to make. So, countries like Tunisia and Egypt will benefit from a lower oil price, but it's not that, evident, I think, in terms of, importing oil at a dollar that is stronger, than it was, just a year ago. So in terms of subsidies, I think it's going to help these countries deal with subsidies. I think the United Arab Emirates, for example, has been dealing with this issue. So some of these countries will have easier time to eliminate subsidies or cut down subsidies because of the lower, oil price. But cutting subsidies is not, easy political, matter. It could create, social unrest and political, as we have seen it, in many countries. So those are the comments I could make. Thank you.
We'll turn to the audience. We'll take a few questions and then direct your question to the panelists if you have a particular panelist in mind. I see a number of hands. We'll start with the young man right there.
Hi, thank you very much for this informative panel. My name is Namo Abdullah. I'm a journalist with Rudao TV from Kurdistan. I have a question about the relationship or the potential relationship between oil and the war against ISIS. As we know, the U.S. alliance, the U.S. coalition against ISIS includes a number of oil-rich countries, such as Qatar, Saudi Arabia. I wonder whether there is any relationship between the war against ISIS and oil.
Thank you. Thank you. Gentlemen in the third row as well. Keep your hand up. Yeah, thanks.
Mahfouz Tadros, retired. My question is on the Arab Spring and really the effect of the falling oil prices on home remittances and unemployment in the Middle Eastern countries. Also, how do the panel see the effect of foreign assistance from Gulf countries in particular to the rest of the Middle East?
Thank you. And I urge the panelists to take notes of questions that might relate to them. On the right, yeah, gentleman right there. Raise your hand a bit more so the microphone can find you. Thank you.
Thank you. From the perspective of non-state actors, Boko Haram and ISIL, will the falling oil prices projected over next year be a strategic advantage or disadvantage to financing their operations?
Could you also introduce yourself?
Yes, my name is Anthony Clark. I'm a student at American University.
Thank you. From this side, yes. Mr. Keysweater.
Alan Keysweater with the Middle East Institute in Denton. Is one of the objectives of Saudi policy to, in fact, make non-conventional U.S. producers the swing producers? Is this what's going to happen?
Thank you. There was a hand, yes, right behind you, Megan.
A question regarding Russia. Many Russians that I speak to, both ordinary Russians and more elite Russians, really see this as a plot. I know this is something you aren't going to disagree with, but I'm asking you for talking points. They see this as a plot between the U.S. and Saudi Arabia. And there's, in going to Dr. Seznec's point, they actually, I see a rise in hostility towards Saudi Arabia across the Russian political spectrum. So I wonder if you could comment on Russia a bit.
Thank you. Let's take some responses. Sarah, do you want, if you feel anything was directed to you, we'll go in that order on the panel.
I think just for the one that is political, like alliance, I think that, of course, Saudis will gain political leverages for lower oil prices in Iran, but I see that they're going to gain more on economic and energy because they have share fields with Iran, like let's say share gas fields, and if Iran has less money in pocket and sanctions remain for longer time or investment delays because of the sanction removal process, Saudi is going to make more advantage on the oil side. And also then it goes to the market share. Iran's export capacity, Iran's production capacity, all will be delayed. So I see that more of a economic and oil business leverages that they're going to gain more than politics, or at least that's how I want to look at it, because when I just put the simple like supply demand in a price forecast models, it just things are correct. There's no push or there's no conspiracy to make these prices coming low. It just makes sense.
Thank you. Jean-François?
Yes, it's very hard to answer all these questions, really.
Pick the ones you feel.
30 seconds, yeah. No, I think the point on the Russian is, I think, well taken. I think I can see from the Russian standpoint where they see it's a plot between the U.S. and Saudi Arabia, but I think it's just a plot by Saudi Arabia. I don't think the Saudis are really, I mean, it's a plot between themselves. It's a plot between Ali al-Naimi and the king, basically on, we get the prices up a little bit and, we force Russia to do something on Syria in a way. So I can see where there is some disagreements within Russia about Saudi Arabia, I mean, dislike of Saudi Arabia, because the Saudis are putting a lot of pressure on Russia right now, and they're doing it willingly. Now, whether Alan's point on the Saudis forcing the U.S. to become a swing producer, or the North Dakota, we should say, become a swing producer, de facto, yeah, in a way it is. I'm not sure they thought of it this way. I think they really they view Russia as the swing producer, but they have to sort of put some pressure on the prices in North Dakota, and I think my colleagues will say that a lot better than I can. In terms of the ability to wage war, which was of the lower income in order to wage war, I don't think it'll make any difference whatsoever at this point. The crisis is so big and so intense, it doesn't matter where the money is coming from. I think it will be done, and that's about all I can remember to answer here.
Thank you. Minister Khelil?
I think I'll just address this Boko Haram threat, in Nigeria, northeast. And as you know, I mean, Nigeria is, within election campaign that has been postponed already to March 28th. And you have two contenders, the incumbent, Jonathan, good luck Jonathan, and General Buhari. And General Buhari is from the north. Of course, he's in alliance with a vice president who is from the southwest. So this Boko Haram intervention, during this period has created lots of divisive, situation, and has, with the oil price, going down. Of course, you had the Naira devaluation, in Nigeria. So there's a lots of stress, in the Nigerian economy, which is going to make it very difficult for whoever wins, the election, to deal with this Boko Haram issue. And of course, they have been late in dealing with it. But I think now there's a movement, from neighboring countries, Chad and Cameroon and Nigeria, into a regional force to deal with Boko Haram. So I hope that with the elections, finishing in Nigeria, there will be a strong emphasis on dealing with Boko Haram, attacks in the northeast through this joint regional, force between the neighbors.
Thank you, Herman. Would you like to comment on?
Yes, a couple of points. One on the U.S. becoming a kind of a swing producer. I think that's a very valid point, certainly for the medium term, because when the market forces pushes prices up in the direction of $70, $80 a barrel, you're beginning to see a turnaround again in the tight oil patch, and you'll see an increase in development and production. So that may set the kind of a ceiling of prices in the medium term, and the longer term is different because a lot of projects being postponed now as a result of the low prices could very well lead to a significant escalation in prices by the end of the decade. One other point I think was important related to ISIS, because I think what we see now, Iraq, despite the significant foreign exchange they had accumulated, now has its own financial crisis. Many reports coming out that Iraq has difficulty paying for the salaries of their senior civil servants, paying the salaries of their military. And so what we see in the field, the US partner in the field, the Peshmerga, of course, the Kurds, on the other hand, is the Shia militia, because the Iraqi army does not appear to be a very strong fighting force. So the Shia militia is the fighting force of the Iraqi government, and they are trained by Iran. So I cannot see a rapprochement between Saudi and Iran for that issue alone. I think those issues are going to linger on, for my own view, for a very long time to come. And are not going to be resolved very easily, even if the US or the P5/1 were to come to an agreement the end of March, which is still very doubtful at this point.
Thank you, Herman. Are there any other questions before we close? Well, if not, I think you would agree this has been really a fascinating and a very rich set of presentations, and I thank all of our panelists for being with us today. This will be an issue we will continue to follow, obviously, P5+1, the June meetings. Hope to see you in meetings here, maybe meetings in North Dakota soon.
Oh, it's a pleasure.
But please join me in thanking our excellent panel for their presentation.